Good morning, everyone, and thank you for joining us. Today's session is entitled 2020 Year-End Tax and Financial Planning and Market Overview Webinar. This is an annual session hosted by Counselor Buchanan and Mitchell. We appreciate your flexibility in joining us today in this virtual environment. Our presenters today are Richard Morris and Alex Seleznev. Richard is an Executive Vice President and Director of Tax Services at Counselor Buchanan and Mitchell. He has more than 30 years of public accounting experience working with closely held businesses, their owners and executives. He also has extensive involvement in estate, trust, corporate, individual, and partnership taxation and planning, including compensation, retirement planning, and succession issues. He also has expertise in corporate structuring, entity selection, transaction planning and analysis, and works closely with closely held and family-owned businesses. Richard works with clients who have unusual or complex tax issues that require customized solutions. And this year he has also been interviewed twice by the Washington Business Journal on issues related to Paycheck Protection Program loan forgiveness. Alex Seleznev is a senior advisor and portfolio strategist at CBM and at the firm's financial advisory subsidiary, MBI. He's a certified financial planner and a chartered financial analyst who leads the firm's investment management division. His focus is on comprehensive financial planning and investment management. Alex is a regular co-presenter for CBM, including for the firm's market update sessions, which are being held every other month. This month's session is special. It's typically every other month. Alex is scheduled to co-present early next year on January 19th in a session entitled Everything You Ever Wanted to Know About Social Security But Were Afraid to Ask, and on February 9th, How to Choose a Financial Advisor Strategies to Help You Make the Best Choice Possible. You can register online for these complimentary sessions at cbmcpa.com. For those of you who submitted questions during the registration process, thank you so much. Those have been forwarded to our presenters and are being considered for responses both during and after the presentation during the Q&A phase. If you registered and submitted a question within the last day or so, they may not have gotten to our presenters in time, so please feel free to use the chat box at any time during the presentation. Our presenters will focus on the content, but as I mentioned, we'll get to the Q&A at the end. This session is also being recorded, and for all attendees, you will receive a copy of the presentation slides. Finally, if you are presenting, or excuse me, if you are attending via your phone, please do send your phone number and name to me, jkovacs@cbmcpa.com, so we can make sure you get the slides. With that, I'll turn it over now to Alex.
Well, thank you. Thank you, Joe. And thank you, everyone, for joining us on this crisp December morning. So perhaps for some of you who are less familiar with MBI, we're a subsidiary of CBM. We're a comprehensive financial planning and investment management firm. Our core team consists of 7 professionals. We have 5 certified financial planners. We have 2 chartered financial analysts, and of course, many CPAs as part of CBM. We're a fee-only, fully independent firm, and we always serve as a fiduciary when we work with our clients, which is important. And everything we do is done by our team in-house. And essentially, we want to be your go-to team for anything, financial or investment oriented. So with that, let's get started. We'll talk about the market conditions, kind of like an overview of what happened this year. We'll talk about our outlook for next year, and we'll certainly share some strategies that we're considering at this point with you. So in terms of the S&P 500 index, which is perhaps the most common benchmark for the domestic stock market, we started this year at a pretty healthy 3,200 points. I'm averaging here a little bit or rounding. Now, I'll tell you by perhaps middle of February, when we're getting closer to this almost 11-year bull market rally, I could come up with a good dozen of reasons of why it would stop and why it would end. But coronavirus was not one of those reasons. But then, of course, it happened. And by March 23rd, the U.S. markets, as well as other markets around the world, declined quite significantly, to say the least. The S&P was actually down all the way to 2,200 points, which gives us a decrease of 31%. Then the Fed stepped in. They were the first ones to react by lowering rates all the way to zero essentially, and pumping a lot of liquidity into the markets, which retrospect really helped. The CARES Act passed, which was a very significant legislation, and the so-called V-shaped rally began. And again, it's relatively easy for me to say this in retrospect. At the time when some people brought it up in March and June, that was almost ridiculous to say. As of last Friday, and actually as of the day before yesterday, we're at 3,700 points for the S&P, which gives us a pretty healthy increase of 68% since March 23rd, or 15% for the year. The Dow is up 6%, and then NASDAQ, which is more of a technology index, is up 39% for the year. There was a little bit of a drop yesterday, so it's closer to 37 as of today. Now, in terms of more recent updates, as of last Friday, 305 companies of the S&P 500 were in the positive. That is important for us. Basically gives us an indication that the rally we've been experiencing is more broad-based. If you look at the March and even July results, there were relatively few companies, specifically technology and consumer discretionary companies, that were leading the way. So that's been shifting. They're almost daily, sometimes even hourly updates on the vaccine at this point. There are 9 major developers of vaccine. 4 of them are, let's call them US-based, and the other 5 are international. Of collaboration happening, and perhaps we'll have some results as early as a few weeks from now. And in terms of the mass testing, perhaps we're looking at the end of the first quarter or beginning of the second quarter of next year. And as perhaps many of you know at this point, they already started that in the UK, and they've been doing that in certain other emerging countries around the world. Now, as a result of that, one of the things we've been really experiencing and paying attention to is this rotation from growth to value stocks. In terms of the definitions, again, growth stocks, as the name implies, more growth oriented, have higher revenue prospects, usually sell at higher multiples, technology, consumer discretionary. Value stocks, essentially the opposite, more mature economies or industries, I should say, selling at lower multiples tend to pay dividends. Energy and financials are a good example. Different way of describing the same thing is essentially a rotation from so-called stay-at-home stocks to more, go back to work, go back to business type of companies. So something that we certainly see as a trend going forward. In terms of the sector performance, technology and consumer discretionary still leading the way, 37 and 29% for the year. It's been the case for a while now. And then energy and financials are in the bottom. That said, though, again, for those two, both are up more than 15% for the past 30 days or so. So again, quite a recovery short term. In terms of the U.S. elections, a little bit of old news at this point, and what you're looking at is a slide from our September webinar, where we essentially developed the 3 most likely scenarios from our perspective. So scenario 3 is what we'll likely have going forward, essentially a Democratic president with a split Congress. And from our perspective at the time, and I would say it still remains the case, we do believe this is the friendliest scenario for the stock market. And again, I want to emphasize that I'm only referring to the stock markets here. Some of the reasons include, continuation of the existing favorable corporate tax policy, and perhaps more predictable, not necessarily more friendly, trade and international policy. Of course, we'll be paying a lot of attention to what's going to be happening in Georgia in the beginning of January with their runoff elections, because that will, have some impact on the split government idea. Now, the market certainly liked the outcome. The week of November 3rd, essentially the election week, all 3 major indices were up between 6 to 7% over the 5-day period, which is actually the largest post-election rally since 1932. So the next chart you're looking at is actually one of my favorites, shows you the performance of each major asset class by year from 2010 all the way to year to date. So large cap stocks in terms of year to date, large cap domestic stocks are the best performers, no surprises there. Mid and small caps are the healthy 10 to 12%, especially if you look at it from the context of being down 30 to 60% in March of this year. Emerging markets are up almost 10%, and actually Chinese stocks are the best performing as a country, 25% for the year. Domestic bonds are up more than 7%. A lot of those gains came from the drop in interest rates in March and April of this year. Balanced portfolios, essentially a split of 60% stocks and 40% bonds, are up a little more than 5% for the year. International developed markets are up only 3%. As many of you know, they're also struggling with the virus as much as we do in the US. Plus, there are a lot of structural issues that prevent those economies from growing. In terms of the cash alternatives, money market accounts, certificates of deposit that mature in less than 1 year, at 0.44%. But of course, if you try to keep any of your cash in your bank account today, you'll likely get something less than that. Commodities are in the negative 8% for the year, with the exclusion of gold and silver. Both are up between 25 to 32%. We do think of those as fear assets. They don't necessarily perform well in the long run, but in times of market volatility, they're, for some people, they're your go-to. And then finally, real estate, as measured by the Real Estate Investment Trust Index, public real estate is down 14% for the year. A lot of other information that you can learn from this chart, specifically if you look at the performance of emerging markets and small cap domestic stocks. It's quite volatile. Best performing asset classes in 12, 13, 16, and 17, but then closer to the bottom in 2011, 2015. And this is actually a great visual for how diversification works, the benefits of diversification, how differently different asset classes perform. For those two specifically, we'll talk about them later, a little more later. We do believe that more frequent rebalancing and perhaps more is beneficial. Small cap and emerging markets are not your best, buy and hold type of strategies. In terms of the economic indicators, or some of the key economic indicators, unemployment rates were at a historic low in January and February of this year, 3.5%. Of course, the virus happened, and in April, it's skyrocketed to 14.7. Since then, it's been declining all the way to 6.7 as of actually 6 days ago. That's the latest figure. Now, going forward, a lot of the gains, a lot of the reduction would of course depend on how quickly we can tackle the coronavirus issue. One thing I will mention, so-called full employment or frictional unemployment is considered to be at 5%. So from the pure market perspective, we don't necessarily need to get back all the way to 3.5 for the rally to continue. Again, if you just consider it as one of the factors. In terms of the US GDP, we're expecting a decline of somewhere between -2 to -4.5% actually, and the consensus happens to be 3.5%. In terms of 2021, the vast majority of analysts, actually all of them, are expecting it to be a positive year, somewhere between 4 all the way to 6.7%, with the consensus being 5.3. And a lot of those gains are expected to come from the second part of the year, again, when perhaps the vaccination will be in place. In terms of inflation, it's been essentially non-existent, at least if you look at the CPI, or the Consumer Price Index, 1.2%. We expect it to remain at similar levels next year, unless again we see more economic activity, perhaps in the second part of the year. We do pay attention to this, especially for those of our clients who have significant portions of their portfolio in bonds, because again, they don't have necessarily that much protection against inflation when they invest that way. So something we do pay attention to. In terms of interest rates, this slide is becoming less and less interesting compared to prior years. We're essentially at zero for the essentially all developed nations. Interest rates are higher in certain emerging markets. And in the US, we're expecting the rates to remain this low until 2023, unless, of course, something perhaps drastic happens. This is actually a positive for stock or equity investors because it leaves relatively few choices if you're trying to, deploy your cash. But of course, it's a negative for those who are trying to or need to maintain a big portion of their portfolio in bonds, and for those who are simply, savers and keeping a lot of their money in cash. In terms of the market valuations, as measured by the price to earnings or PE ratio, which is one of the most commonly used, essentially, the higher the PE, the more richly valued something is. Well, the PE ratios remain at elevated levels, even more elevated compared to the last actually few years at this point. For the US, for the domestic market, it's at essentially 35, which is significantly higher for the past, if you compare to the average over the past 20, 30, and 90 years. Perhaps not as much if you compare to the 10. Developed markets at 28, emerging markets at 20. Now, this delta, essentially the difference between the three, that's been the case for a while now. In fact, I cannot recall a year when that would not be the case. It's just how things work. Now, what is more interesting for us this year, especially over the past couple of quarters, is this difference between different subsectors. And if you look on your top right, if you look at the US large growth companies, they're selling at 41 versus large value at 22. Well, that's almost double. And it's even more dramatic if you look at smaller companies, small growth versus small value. It's 2.7 times. So when I refer to the sector rotation, well, this is one of the metrics that people will be paying attention to. So in terms of our market outlook for 2021, we are cautiously optimistic. We do believe 2021 will be a positive year for domestic as well as international, especially actually emerging market stocks. Again, will be the primary driver of this, optimism. As I mentioned earlier, there are 9 different companies that are developing a vaccine at this point, and there's actually a lot of collaboration between different countries, which again keeps us optimistic. In terms of the stimulus package, if you ask me, a couple of weeks ago, I would say perhaps we're expecting it in January of next year. The latest iteration of it came from the White House, actually. They're proposing a $916 billion package that would include a liability shield for employers. Another round of direct payments of at least $600 per person was not included in the previous one, and aid to state and local governments. So perhaps something like that will pass sooner than January, February of next year. If that doesn't happen, by the way, more than 12 million people will lose their unemployment benefits the day after Christmas. In terms of the monetary policy, essentially what the Fed's been doing and other central banks around the world, we expect monetary policy to remain accommodative, which is again a positive for stock markets. We do expect more volatility, especially in the beginning of next year, first and second quarters, for the reasons that I mentioned just now. Again, the way markets normally work, they always discount what's going to happen over the next 3 to 6 months. So perhaps some of the gains that we're experiencing now are essentially borrowed from next year. So if we have more good news next year, but they're not as good as originally expected, well, that would result in more volatility, especially when the valuations are this high. So we want to be prepared for that. Of course, continuation of the rotation from growth to value stocks, perhaps the theme for the next year. I am not implying here that technology or consumer discretionary stocks are bad. They're going out of business, nothing of that nature. It's just that when they're selling at such a high multiples, perhaps at some point people will begin taking some gains off the table and moving their funds to something more reasonably priced. And then finally, on fixed income, we continue to expect low yields and also low returns because, again, interest rates are essentially at zero at this point and expected to stay at that level for actually a couple of years. In terms of our strategy, something that we've been doing for our investment management clients over the past month or so, well, diversification remains key to success. We continue to believe that, and 2020 is, again, a great example of that. bonds and large cap stocks were the best performance in the first 2 quarters of the year. Emerging markets performed really well in the second and third quarters. And then so far, at least for this quarter, it's really mid and small caps leading the way. If you notice that some of your investments or some of your sectors in your portfolio, stock sectors, really bubbled up, we do believe this is a good time to take some gains off the table and rebalance into other asset classes, or perhaps simply rebuild your reserves. Again, if you want to take a more conservative position and prepare for more volatility next year. If you're heavy in bonds, meaning perhaps you're in pre or post-retirement years, well, consider revisiting your expected rate of return. And if you're counting on something like 4 to 5%, maybe even 3 to 4, well, perhaps a more realistic expectation would be something like 2 to 3 at this point, if not less. If you must stay in bonds, well, focus on higher quality and shorter term bonds. There's simply not much of a benefit in terms of lowering the quality or extending the maturities of your bonds. Depending on your risk tolerance and your financial plan, consider certain alternative options. Again, stocks that have a history of not just paying dividends, but also increasing those dividend payments. Consider preferred stock. Yields roughly 5% at this point, not as risky as stocks or common stocks, but certainly not as secure as bonds, somewhere in the middle. And then finally, multi-sector and total return strategies. They tend to provide higher yields at higher risk, of course. So perhaps a better option compared to more traditional bond strategies. For those of you who are more aggressive or growth-oriented, consider revisiting your allocation to emerging markets, especially Asian markets. They've been handling the coronavirus situation, I would say, better than many developed economies, and perhaps their recovery will happen quicker and be more robust. Plus, with the U.S. policy perhaps becoming more predictable, that would be a benefit. And then finally, if you do believe that the economy will recover at some point, consider putting a portion of your portfolio in more economically sensitive companies, such as mid and small cap stocks. And that's part of the rally that we've been experiencing lately. They're the first ones to go down, but they also tend to be the first ones to recover. So with that, I will ask Richard to share some of our tax strategies with you.
Thank you, Alex. It's been quite the year for all of us. Good morning, everybody. As we saw, the world keeps moving. We've got a number of things we're going to cover here. Some it seems like we're going to go faster than others, and that's true because we have about 2 hours worth of stuff we're going to push into about 30 minutes. So right now we're talking about sort of traditional year-end tax planning. Charitable giving, yes, it's still a thing. Donor advised funds. And then this is something where you can make a sizable contribution to what is called a donor advised fund. And then get the charitable deduction this year and then make distributions from that fund in subsequent years. Really, it allows you to front load the deductions into a year where you can benefit from them most. If you've had a liquidity event or something unusual there. It can be made up of cash. It can be made up of your RMDs. So that's an option there. Loss harvesting, traditional loss harvesting. Alex talked about the market having gone up and down. Believe it or not, you may have some losses. This is the time to review your portfolio and see if there are any losses that we want to take because we have these gains, or losses that would enable us, as he talked about, rebalancing. Rebalancing usually means incurring some gains. Look and see if you have losses as well. We tend to look at the winners, not so much the losers. We're going to talk about estimated tax payments. We're going to talk about the review of the impact of this year on next year. So transactions that you may be able to close this year or next year and how you'd be affected by that. Bunching donations. That's a technique in which, because the standard deductions are so high now, a lot of people aren't able to itemize. So if there are certain expenses you can shift from one year to another, you might be able to get some benefits there. So if we go to the next slide, we talk about gain and loss harvesting. Believe it or not, the amount of capital losses you can claim in excess of your gains is still $3,000, and that goes back 30-something years. So, I mean, that goes back a long time. I had a lusciously thick head of hair at that point, and 35 years later, it's still $3,000. So it's not as great a tool, and there is no talk of changing that. There's still preferential rates on long-term capital gains. If you look at the bottom right of the slide, you'll see that there are certain income levels where you pay 0% on your long-term capital gains. Okay, if you're single and your income's up to $39,375, you actually pay 0 on that. So again, look at your portfolios, and then you see that we always say the 15% or the 20%. Those depend on your income levels, other than the capital gains. Let's go to the next slide. There's also, what that doesn't talk about is the net investment tax, the 3.8% that's on top of that, but we'll get to that. Some other traditional strategies. At the end of the day, we don't like to pay penalties. We might not have a problem paying interest sometimes. We don't like paying penalties because you never get that money back. It's lost to the system. So there are rules to protect you, and they're called the safe harbors. And the basic one is 90% of the current year tax. Okay, if your tax at the end of the year is $100, if you have 90 paid in through withholding or various ways, you're covered. But if your income went up and you don't want to do that, then there are other what we call safe harbors, 100% of last year or 110% of last year, depending if your income was really high. SALT limitation. We're going to talk about that a lot as well. I mean, that relates to your state and local income tax, not a dietary situation. Again, look at your carryovers. You might have some charitable loss carryovers. You might have some charitable carryovers, long-term capital gains, passive losses. Look at those things for a year and see there might be situations where it's worth taking some income to be able to get these deductions, and that comes down to timing. Also, make sure you don't, if you're able to, make sure you don't miss out on funding your retirement plans as much as you can, especially if there's some employer matching. Those are free dollars. We never turn down free dollars. The max is this year is $19,500 for those over age 50. There's a $6,500 catch up that you can do as well. Those are unchanged for next year. Let's go to the next one. I want to talk about sort of how do we get here? What the heck? So we're in year three of the we're referred to in shorthand, the Trump tax changes. Okay. On top of that, we had the elections. On top of that, we had the Secure Act, which was actually last year around the time we did this presentation, which changed retirement plans. We had the first Families First Coronavirus Act, which is some credits we're going to talk about. And then we have the CARES Act, which everyone is probably pretty familiar with at this point. Let's go to the next slide. Again, we're sort of rewinding and saying, where the heck are we? So remember, the standard deductions were dramatically increased. You lost your personal exemptions, but they were increased. And so this is just showing you inflation adjusted for this year. It's 24.8 versus 24.4, and it goes down the list. So that's pretty much unchanged. The estate and gift exemption, 11.58 million per spouse. Okay, that's really big coming up because that's one of the things that's in the target of the new the incoming administration. Maryland and Virginia have no changes to their estate rubric, but DC is going down $1 million. So for someone who passes away in 2021, it will be 4 million versus 5 million if someone passes away this year. Moving on to the next slide, we'll see that it's unchanged. There's still 7 brackets. The AMT really didn't go away, but it went away for almost 90% of taxpayers because the first thing you add back for the alternative minimum tax is your state and local tax. So if everybody's capped at only 10,000 state and local taxes, not a big add back, but it's coming back. And then the capital gains rates are unchanged as well. Moving on to the next slide, and again, you're going to have all these available from Joe. You can find your tax bracket here. This gives you an idea where you are. But I'm going to direct your eyes to the bottom of that screen where we have the 37% bracket. Now, this is taxable. This isn't gross. So this is after your deductions or standard deduction or itemized deductions. So for a single person, you're in the top bracket at almost $519,000. 622,000 filing jointly. So these are pretty, it takes a lot to get into these high brackets. Spoiler alert, under the new administration, 400,000 is the new top rate. Okay, so we're going to get to that, but this is just sort of to program your minds for when we get to this in a little bit. Let's move on to the next slide. And we talked about these big standard deductions. Does it make a difference? It makes a difference. So remember, it was 24.8 for a married couple filing jointly. So it's 24.8. So all right. So can I get there? Well, your state and local is limited to 10,000. So that means you have to get to 14.8 from other places. Okay, what does that leave for most people? That leaves charity and mortgage interest. For some people, you're still carrying a fat mortgage, you're going to get there. For a lot of people, unless you're really generous, it's a tougher hurdle. How much is it? Nationwide, only 14% of people itemize. Only 14% of filers. Can't track non-filers. Only 14% of filers itemize, okay? Because those rates are so high. Because houses don't cost as much as they do in the DMV. In some cases, because state and local taxes aren't as high as they're in the DMV as well. That is almost half of what it was prior to that, just to give you an idea. But charitable deductions, there's been a lot going on in the last number of years. The 2017 Tax Act increased the amount that you can deduct up to 60% of your adjusted gross income. You made $100,000, you could deduct up to $60,000, 60% for charitable contributions. Well, this year and this year only, out of the CARES Act, it can be up to 100% if it's cash money. So cash money to your standard, public charities. So this is an opportunity. I mean, we talk about this is an opportunity. If you're feeling generous, this is the year to sort of blow those caps off. And if you're thinking of some sort of a legacy gift or something like that, this saves you real money. 100% of that. It only applies to cash to public charities. Doesn't apply to private foundation. Doesn't apply to appreciated stock or property. So that's something, if you're thinking this is the year to be charitable, keep that in mind. There's also another change that even though we itemize, that everyone can take up to $300 in above the line, we call. So in addition to your standard deduction of $300 for cash contributions. Again, if I haven't touched on it, documentation. Okay. The audit percentages are really low, but if it's you, it's all about the documentation. If you have the documentation, it's pretty painless. If you don't have the documentation, you have challenges. The state and local tax limitations, SALT, still 10,000 for state and local income and property taxes. So again, most people on here, certainly if you're Maryland and the District of Columbia, I mean, your property taxes alone can be pretty significant on top of your state income taxes. Virginia's is the lowest state income taxes. People on this call. Let's go to the next one. So still, there's some. When this act was passed back in 2017, it was already scheduled to sunset. I mean, it was already scheduled to go away. So some of these changes would have happened or are scheduled to happen regardless of a change in administrations. The big one around here is the mortgage interest deduction limit went from $1 million down to $750,000, only if you've purchased your residence since then. The other change is you can't use your home equity loan to buy a car. Well, you still can, but you can't deduct it. You can only deduct your home equity interest if it's used to improve the property, and then alimony has not been deductible. This will be the second year now. So that was a big change as well. On the next slide, we're going to talk about some retirement changes. So the Secure Act sort of went through at the end of last year with everything else going on, sort of got lost in the wash with the coronavirus legislation that was coming back. Removed one of the odder parts of the law, which is the age 70 and a half for required minimum distribution. RMD is required minimum distribution. So, briefly, the concept was the government lets you put this money away tax-free, but is not willing to wait for your eventual demise for it to be taxed. So they said, okay, at a certain age, you have to start taking money out. Well, 70 and a half, you have to find out when people's half birthdays are and all that. So now they said you're age 72. But it is not the year. It is you have to be past that age, okay? So we have had people where, July 29th birthday, they pull the money out July 25th, doesn't qualify. Seems weird, doesn't qualify, okay? So, but it's moved it back to age 72. So it buys some time. People are living longer anyway. If you can afford to, not a bad thing. You can now contribute. So, good stuff for people in the 70, 71, and 72. Remove the age-based limitations. There used to be a cutoff above a certain age you couldn't contribute to an IRA. The stretch IRA. So most people's IRA beneficiaries are a spouse and then their children. And when it goes to a spouse, pretty straightforward. The spouse treats it as his or her own. But if it goes to a non-spousal beneficiary, historically, then it was paid out over that person's lifetime. The RMDs were over that person's lifetime. So if you were, unfortunate enough as a 20-something to have a parent pass away and leave it to you, you were paid that out over 50 years, okay? Government takes a long time to get that, okay? Some of it's about equity, some of it's about raising revenue. So they said, you know what, we're done with this stuff. You have 10 years, okay? It doesn't mean it has to be 1/10, 1/10, 1/10, 1/10. It literally can be 0, 0, 0, 0 for 9 years and then all of it the 10th year. But you have 10 years now if you're a non-spouse to take a distribution. There are some arcane exceptions, minor children. Well, they're not arcane if it's you. But, not grandchildren, for example, special needs. So there are those things. But the basic rule is you have 10 years now to take those distributions. So it does allow you some flexibility if you're in a high income or a low income year to sort of pick and choose. But the ultimate thing is you have the end of the 10th year. And then 529 accounts can be used for student loan repayments without incurring the penalty under the early withdrawal. So related to that, qualified charitable distributions. This has been around for a while now, which basically said you can go directly from your IRA to a charity, should you so choose. And why would you do that? Well, you would do that because if you take an IRA distribution, it goes into your income, which increases your adjusted gross income, which triggers all sorts of limitations and things like that. So there are situations where it's more beneficial from a tax point for the money to go straight to the other. You don't get the deduction either. But again, it's about reducing your adjusted gross income, which could affect Social Security, which could affect medical deduction, could affect all sorts of things. So that's on the right case, for high income people who are still charitable minded, it's a good tool. It's a good tool to have out there. Doesn't pick up an income. And obviously, it's something you want to look at prior to the end of the year. It does take some time to make them happen. So if you're going to do it, it's got to clear by the end of the year. So we've talked about individuals. Let's talk about some businesses now. And a lot of this is going to be a recap. 2017, corporations used to have graduated rates, flat 21%, no AMT. It introduced this concept of qualified business income. And basically, if you had certain types of income, you got an additional deduction, which really amounts to a rate reduction. And that was whether you're an individual business person who itemized or didn't itemize, whether it's Schedule C, partnership, S Corp. And the idea is to bring individual rates closer to the corporate rates. So the genesis of the whole thing was our corporate rates were way out of whack with the rest of the world. So they moved the corporate rates down. Well, then individual rates were still that much higher than the corporate rates. So this is an idea, a concept to try to bring them together. And moving on to the next slide. I mean, the idea was for non-corporate, individuals. People say the corporate tax collections are down. Yes, because most businesses are set up as pass-throughs, partnerships, or LLCs and those things. So this is the QBI, and it's a pretty complex, even from a tax perspective, it's a pretty complex calculation. But basically, if you employ people and you employ assets, you get to avail yourselves of that. And the limitations don't apply for certain really small businesses. So let's move on. There was another thing that was another concept, which was a limitation on business interest expense. And that got to sort of back to feeding where Alex was. Debt was so cheap, rather than raising capital, people were just going out and buying it. And then businesses were going, wait a minute, this guy's getting a deduction for his financing, but I have to get investors and pay them dividends. I don't get to deduct that. I'm not getting treated fairly. So they said, all right, we'll limit for a business, we'll limit your interest expense deduction to 30%. Well, now, the CARES Act raised it to 50%. And again, if you're below a certain size, the limitations don't apply, but that was about the economics. On the next slide, we're going to talk about depreciation, which is where some of you will go get a cup of coffee. Under the law, it's cost recovery. But if this applies to you, this is serious business. So, there are lives to certain assets. A building is depreciated over 39 years, but parts of that building are depreciated only under 15, qualified improvement. So the parts where you see clients, the public-facing spaces. So restaurants, that's a big deal for restaurants even before all this. So they got this correction for qualified improvement property. So all these restaurant fixtures and those things, and showrooms and waiting rooms and patient areas got to depreciate at a much faster rate. So 15%, over 15 years. So at a much faster rate than 39 years. And that was just something that they screwed up when they wrote the law in 17. The CARES Act corrected that. But it's really sort of think of public-facing spaces. And then the part of depreciation everybody talks about is automobiles. So we're going to go on the next slide. And unfortunately, we're not here in person, so don't get to ask how many people drive a luxury automobile. But I'm guessing you all do under IRS laws, because under IRS law, any vehicle that costs more than $18,100 is a luxury vehicle per se. So that gets to these depreciation limits. And you see for a luxury car, with this new bonus depreciation, which is where you get to write off an asset in the year you acquire it, it's 100% through 2022. And that's where this 18,100 you see on the screen is for a car. If it's more than 18,100, then you take these amounts over the subsequent years. But that's the definition of a luxury car by your government. Moving on with our last depreciation slide, Section 179. This is a provision for businesses where you can write off literally up to $1 million of assets you place in service, as long as you don't place in service more than almost 2.6 million during the year. So even though we say it's 7-year property or 5-year property, you get to write it all off. It does not apply to real estate. So there is that catch in there. So now let's catch up with this year. Let's talk about all the COVID stuff. I talked about the qualified improvement property. This is sort of where it gets interesting now. So now if it went to 39 to 15, you can take some bonus. You can get, instead of 2.5% deduction, you get 100% deduction. So if it applies to you, let's talk. One of the big things from the COVID legislation is the employer portion, because remember, employee pays half the FICA, the employer pays an equal amount. Okay, 7.65% for each party. So as part of the coronavirus relief, it said, all right, businesses will allow you to defer this year's employer contribution. Okay, not the employee, you still got to pay that to the government, but the employer's portion, you don't have to pay this year. As long as you pay 50% of it by end of 2021 and the other 50% by the end of 2022. Okay, so these can be significant dollars. If you think, you're paying somebody $100,000, you're paying another $7,650 to the government in Social Security tax for them, which means you can defer $3,800 till next year and the other $3,800 till the subsequent year, interest-free, no strings attached. So this is the equivalent of money in your pocket because it's not taking money out of your pocket. And then there were myriad payroll tax credits. Again, it was designed to keep people, employed, or keep people paid even if they weren't working. Employee retention credit, paid sick leave, paid family leave, and there were some steps you had to go through. But again, it was the government's trying to put money in your pocket or not take it out of your pocket. PPP, Payroll Protection Program, loan forgiveness application has opened. Those are due 10 months after the deferral period ends. For most people, that's could be as late as December 31, 10 months after that. We have time on that. I know the banks are reaching out on that. So let's talk about that. This is the 8,000-pound gorilla in all businesses year-end tax planning. Okay, is these PPP loans, because it can create taxable income. But let's go back. The idea of these loans was basically to shovel as much fund money out the door as quickly as possible. And it worked. Okay, it worked. All that, those trillions of dollars got out there. And the idea was, as long as you spent it for these certain things, which is basically your business stuff, your payroll, your rent, your mortgage, your utilities, what does it take to keep that business operating? That was the test. That would qualify for forgiveness. And now the government said, great, it's forgiven, but you don't get to deduct those. You don't get to deduct those expenses. So people are left scratching their heads. And so let's go back a little bit. The basic of tax law is you can deduct any expense, any legal expense incurred to generate income. Okay, we pay rent here. Okay, it's deductible. So the theory is any reasonable expense incurred to attempt to generate profit is deductible to generate income. By that same token, if I'm getting tax exempt income, I can't deduct that. The easiest thing is if I pay Alex to buy me a tax exempt bond, by definition, I'm not picking up the income of that bond, it's tax exempt. I can't deduct what I paid him because I'm getting a deduction. The economics don't match. I'm getting a deduction for something I'm not paying tax on. Sort of one-sided. So, buried deep within the law, long established law, was to the extent, using my same example, if I'm not picking up the income from the tax exempt bond Alex bought me, I can't deduct the Alex fee. All right. So extending that concept, if the government forgives your loan, and as long as you didn't, frankly, spend it on stuff you're not supposed to spend on, it's going to be forgiven, then I can't deduct those expenses that I paid with that. All right. I borrowed $100 under this thing. I paid salaries with that. I'll make it easy. Okay. Government says, great, you don't have to pick up the $100 that we gave you, but you can't deduct the $100 of salaries that you paid. All right. And before people say, that's unfair, that wasn't the intent. It wasn't the intent. I mean, this never came up back in March and April. The idea was the economy's going down. We got to get a lot of money out there. So a logical question would be, well, why don't I just pay the loan back? I'm not your financial advisor, but if you pay the loan back, if you paid back that $100, then you're out the $100. At least in our example, if you end up being taxed on that, you still have net of the tax. So if I go back and say, well, my tax rate was 30%, in my example, I still have $70 that I didn't have before. So every chamber of commerce, every accounting society, every business group is beating down the doors on Capitol Hill to get this addressed. But right now, the law is that those expenses that you pay with the loan that you're not picking up an income are not deductible. As if and when that changes, trust me, you will hear about it from us right away. But that is the thing that is driving every projection, every analysis that we're doing for somebody who actually got loan proceeds. That is the biggie. And also, I know a lot of the banks are reaching out to people and say, start your forgiveness now. You don't have to. Remember, we said you have 10 months. Not saying to put it off until the summer, but let's wait into the new year. And frankly, let's wait until there's a new Congress. And to be perfectly blunt, wait until people start having to file tax returns and see what the hue and cry is at that point, that what happens. So let's talk about the president-elect. This is all from written proposals that the campaign put out there. So in terms of individuals, increase the top rate, okay? But short version, it's raise rates and limit deductions. Why do we limit deductions? The reason deductions are limited because it's not as transparent as just raising the rate, okay? If I say, you know what, we're not going to change any rates, but you don't get to deduct anything. Well, when we've effectively changed the rate because we're not giving you any deductions. So this would increase the top rate to 39.6 rather than the current 37% for those making over 400,000. Remember, right now we were seeing 500 and 600,000 back on like slide 13 or something. Capital gains, this is the biggie. Remember, capital gains have a preference now. Preference, which means they're taxed at a different rate, at no more than 20%. Well, this is to bring them back to the ordinary rates of 39.6% if your income's over $1 million. 39.6, this is the this is back to the pre-Trump top rates. That's where that comes from. The child tax credit, this is a good thing. It would be increasing it to $3,000 for kids between 6 and 17 and $3,600 for kids under than that. Restore the P's limitation if your income is below $400,000. Pease was a congressman from the Midwest who came up with the idea of limiting itemized deductions rather than raising rates. Say, wait a minute, we won't raise the rates, we'll just limit their deductions. And that is, you take a haircut on your deductions of 3% if your income's over a certain amount. And that used to be if your income was over $100,000, which again, it's a lot of people in this area. So your effective rate's going up, your statutory rate's not going up when deductions are limited. Also, they would cap your itemized deductions at 28% of your income if your income's over $400,000. So you'd have a lot of limitations. You'd have your P's limitation, and then you'd have it capped at 28%, not with a carryover, just capped at 28%. It would end the SALT tax, or the SALT cap. Great news. End the SALT cap. I can deduct $100,000 worth of state and local income taxes. Bad news. I add them back to the alternative minimum tax. I mean, that was sort of the part that got lost in the wash, was that all these people were paying alternative minimum tax when they got to deduct all their state and local taxes. And then student loans are canceled if you're in a repayment plan. Let's jump to the next slide and hit the estate pretty quickly. This is the one that's driving a lot of qualified personal residence trusts and gifting, and this is the one everybody's really focused on, which is that exemption is going to be cut by $8 million under the proposal. The tax top rate will go to 45% over 40, and then additionally, it shifts all the burden to the recipients that you don't get stepped up basis. So right now, if grandma bought SO stock back in 1960, and that $1 of Alex will correct me later on the value of it. That $1 of SO stock back in 1950, even with it is now worth $30. I would inherit that at $30 under existing law. Under this proposal, I would inherit it at $1, and now if it's worth 110, then I'd have to pay the capital gain. So it's shifting capital gains tax to the beneficiary on top of the estate tax. One last on business proposals, it's basically to raise the business tax rate from 21 to 28. But also on the business slide, it's to impose an additional payroll tax on wages above 400,000. So, as business owners, that's real, that's real money on salaries over 400. We are ready to take, if we slide to the upcoming events so I don't forget them. Yeah, that's the one where it shows the 12.4%. There's one, I think December 17th, we have one coming up for year-end tax planning for attorneys and professional services. You see on the 19th of January, Social Security, and then 2 scheduled already in February. Right. We do have a number of questions. So, Alex, if you want to queue them up.
Absolutely. Absolutely. Yes. And for those of you who are participating, if you have any questions, please type them in the chat box and we'll try to address them. All right. Here's the first one. Update on any anticipated changes that are likely to be retroactive to 2020. What do you think, Richard?
That's a good question. So 2020 will be closed before there's a new Congress seated. So 2021 is in play, not 2020. So while legislation can be retroactive to the beginning of the year in which it's enacted, it historically has not been retroactive to prior periods, because then you're punishing people for following the law at that time. So really the question on this one is, what will the effective date be on new legislation? Usually it is prospective when there's a tax increase. When there are tax cuts, they make it retroactive to January 1. When there are tax increases, and all of these except for the child credit, are increases at this point, they are prospective. So if they pass it by, May 15th, then it probably has an effective date of, May 15th or October, whenever it passes, but nothing that's going to affect 2020. So you can take all those 2020 provisions to the bank.
All right, here's another one, short one. Deductions for teleworking since March, question mark.
So unreimbursed employee business expenses used to be deductible. If you were incurring some expense for whether as an employee or as a business owner, those were used to get them at the bottom of your itemized deductions. Those went away. Those went away in exchange for, one of the things that went away in exchange for the huge step up in the standard deductions. So there's not a place, frankly, where you would deduct those. So the recommendation here would be, and I presume you're talking about having to buy additional monitors and things like that, I would frankly ask the employer to reimburse it, because then the employer can have it on their books and frankly claim the depreciation that we talked about, and then you are made whole. So you're getting better than a deduction, but because you're getting a dollar for dollar reimbursement for, it's probably technology and those sort of things, the ones people are going for.
Thank you, Richard. Here's another one, a little longer. If you have extra cash on hand at end of year, is it a good idea to pay off part of small business COVID-19 loan from SBA, for example, or prepay health insurance premiums or medical payments?
That's a good question. So let's say you were, and there are some people that say they want to treat these PPP as loans, and because it's a really low interest rate and it's 2.5% and a 10-year payback and all that. But the counter to that is just the raw economics. I mean, this is, you've been enriched by this money. So, it would be an unusual set of circumstances to pay it back, to be advantaged by paying it back. So I would say, I would look at those, again, those deductible expenses, health insurance and, forgive me, Alex, what was one of the other ones? Health insurance and?
Prepay health insurance premiums or medical payments.
Yeah, I mean, so those are deductible expenses, whether you pay for it with your own money or borrowed money. So, I guess another way to look at it is, if I can borrow money from somebody else to pay my expenses, I think that's a win-win. Wouldn't you think, Alex?
Absolutely. Yeah. I'm definitely in agreement. Okay.
Yeah. All right.
I guess we have time to take up a few more. Setting up a QTRP before year's end to avoid a possible change of the limit on estate tax savings, where the value of the home will increase greatly by the time it goes into the estate. So I guess the question is this a good idea?
Yeah. So I mean, this is, and everybody else has been scrambling to get a lot of this stuff done before the end of the year. Keep in mind, the law is the law until it isn't. So, I may say the law is going to change by this date or whatever. If you can tell me how all these runoffs are going to go, then, maybe we can do it. But the risk here is $8 million per spouse. Okay. The risk here is going from, 11.8 to 3.8. Okay. And that's the calculus you have to do in your head, because what these trusts do is you put, usually it's your personal residence. You put it in a trust and you lock in the value as of today, okay? And you pay the gift tax on it. Gift and estate are the same thing, just matters whether you're dead or alive. It's the same rates, same limits. So what the idea with those exactly is, you're locking in that value today. And then, hopefully long in the future when you've passed, is appreciated greatly. And all that appreciation is out of your estate. That's the concept here. So this is where it is absolutely worth, doing the economic analysis of it to figure out what it is. But then, look at because there are some restrictions on these things. I mean, there's some, hoops and things you have to jump through. And your comfort level with doing that. But yes, I mean, this is where people are looking at taken advantage of this. And this is something where, no, there wouldn't be a retroactive tax on it if you die when it's $3.5 million, but you gave the gifts when it was $11.5 million. That would be respected. But absolutely, it is a worthy, it's pen to paper. Do the exercise. And if you're at, if it's an $8 million risk, that would solve it for me pretty quickly. Worth paying some accountants and lawyers to make it happen. So.
All right, and here's actually one, Richard, from the chat box. I guess it's a follow-up to not this one, but the previous question. What about 24 weeks for proper use of funds under PPP and then apply for forgiveness next year? 24 weeks up this month, I believe.
Yeah. So the IRS came out with, and that's a great question. The IRS came out with a ruling that said, because people said, well, I'll just defer the applying until next year. And they said, basically, if you reasonably expect it to be forgiven at any point, whether this year or next year, it affects your 2020 tax year. Okay. So if I've spent it for what, those approved uses, there's really no reason for me to not be approved for forgiveness. That was what the law said. We'll give you this money. If you spend, percentage of it on this stuff, we're going to forgive it all. So they came out with the ruling and said, if it's reasonably expected to be forgiven, which is, do your homework so you actually spend it on, then it's going to be treated as a 2020 transaction. Whether you apply for forgiveness in 2020 or 2021, it reverts back to this year. Now, there is a opportunity for self-employed people because, one of the expenses is a salary, and self-employed people, Schedule C, you can't take a salary. So for those, that's not an income situation. So there's actually if it's for you, it's a loophole. If it's for your neighbor, it's a tax dodge. But, if you are self-employed, Schedule C, and you've only spent it on, your draw, then there's a situation there where it wouldn't be taxable income to you. But the forgiveness is a big thing. But basically, they came out with a ruling specifically on this point that said it's a 2020 transaction as long as you've met the facts and circumstances there.
Thank you, Richard. And I guess one final question here, changing subjects a little bit. Should nonprofits include the PPP forgiven loan as a grant? And part of the same question, should nonprofits report the expenses used to obtain the PPP forgiven loan? Are they deductible?
Yeah, the nonprofit, that's a whole different, because you're not necessarily answering to shareholders, you're answering to GuideStar, and people look at it because it's all, it's all public out there. And of the groups that gave money back early on, once everybody was sort of outed, a lot of it was not for profits because they didn't want so they sort of have their own set of, we'll call them, non-tax issues. But the treatment wouldn't be, would be similar to a for-profit institution. But, we are sympathetic to the scrutiny there, and part of it is having a, understanding what the narrative is. And I go back to, look, in March, nobody could have told you, because now we're going to, there will be stories that look back and go, well, look at this business. They got a PPP loan and they had a record year. Yeah, those are out there. But when it happened, there was nobody that could reasonably say, well, I know the recovery that Alex talked about. I knew that was coming all along. If they did, they kept really quiet about it. So yeah, no, there's another whole level of complexity for not-for-profits for sure on that. So.
All right, so Richard, it's a little after 10. Would you like to address more questions, or should we take them offline? Your choice.
I'm willing to go. I'm willing to go.
Okay.
A lot. People are willing to stay on. For those of you that are leaving, thank you very much. Merry Christmas, Happy Hanukkah. Truly wish everyone a healthy New Year. We used to say healthy, happy, prosperous. Right now we're looking for a healthy New Year because we think that other stuff will follow. But for those that are willing to stay on, and if Alex is game, I'm game.
Sounds good. So here's another question again from the chat box. Can you please elaborate on Schedule C, self-employed PPP forgiveness comment you just made? All my PPP went to salary.
Okay. So salary isn't deductible on a Schedule C. There's, you know, because Schedule Cs are different because you're the employer and you're the employee. But if you look at a self-employed person's return, there's no salary line on there because you're taxed on all the income that it makes, whether you took it or not. Okay, so there's no deduction that's claimed. I mean, the deductions that you claim would be rent, supplies, all that other stuff. But there's no salary deduction on there. So going back to this whole forgiveness thing, again, I borrow $100 and you know, I have $10 of internet access. There's $90 there that is in essence then is salary. Well, that's not a deduction. And the way the law is written, it's deductions. So, you know, only in this case, only $5 of it would be taxable as income to you because that's the expenses that were paid out of the loan proceeds. It's really an odd. It seems sort of counter to everything we said the last 30 minutes, but because and partnerships are similar in that you're taxed on the income whether you take it or not. So if there's no salary deduction, then there's no salary to be forgiven.
All right, here's another follow-up for you, Richard. But if self-employed and payments to third parties under PPP, aren't third-party amounts deductible?
Yeah, third party. Yeah, no, we're just talking about yourself. We're only talking about you, the Schedule C person. If you look at a Schedule C, there is no line for owners' wages. It's for employees, sure. So this is only the owner portion. It's not everything. It's just the part that would be the owner's wages. Although I hate to use that term because they're really not wages by definition from a self-employed person. So the same rules apply to your other expenses, to your rent, to your supplies, to your equipment and all that.
All right, here's another one. When you answered earlier about paying off some of CARES loan with excess funds at end of year, did you ultimately say yes? Pay off with the borrowed funds, question mark. Heard the lead up, missed the punchline.
Pay the expenses, but I mean, it's a really rare set of circumstances where it's economically advantageous to pay back the loan. I mean, it's just, I mean, from a tax purpose, and there are non-tax reasons people pay them back. I get that. But again, you've been enriched. You have been given money that at worst you have to pay tax on. Okay, well, net of the tax, I still have more money than I had before. So economically, I mean, you can pay it back over 10 years and that time, but why, you know, again, I go back to why give back free money. And yes, I get that there's some tax to it, but you still come out net of the day. You know, there's no 100% tax rate, so you still come out ahead. I hope that clears that up some. Alex, if there's something you think that can clarify that.
Oh, I think that's as clear as it can possibly be. Even I get it. So, all right. Well, I don't think we have any other questions. Of course, if any of you have any, I guess, more personal questions, feel free to reach out to Richard or myself directly. You have our contact information on the slide. And yes, happy and healthy, most importantly, healthy new year to all of you. Thank you for participating in our webinar today.
Thank you, everybody. And thank you, Alex.
Thank you, Richard. All righty.
Take care, everybody.
Bye, everyone.